Okay, good afternoon, everybody. Thank you for attending RHB Group's second quarter outlook for global markets and the economy. I want to start with first describing how we got here and then what is essentially our ultimate destination in the second quarter, as well as for the remainder of the year. So the last couple of weeks have been fairly turbulent with essentially risks in the U.S. banking sector picking up. Credit Suisse Bank, having been acquired by UBS, and market sentiment turning quite bearish in terms of the future path of the U.S. and global economic activity. In terms of how the market is priced currently, or positioned currently, it's positioned mainly into cash and less so into conventional assets such as equities and fixed income. We have been seeing those cash essentially going through money market funds, money market instruments, and the pickup in essentially crypto type of currencies in terms of momentum is also a reflection of the cash that is sitting on the books of both institutions as well as retail investors. So that's the history. Now, where do we go from here? So the three key messages are, first and foremost, from a global asset allocation perspective, similar to what we mentioned to you in our December podcast on the 2023 outlook. For the second quarter, the song remains the same. We are overweight equities, market weight fixed income, and underweight cash. Markets are, most investors at the institutional level are mostly into bonds and cash. So we have a very kind of consensus view in terms of the headline message really is buy risky assets on dips in the second quarter of the year. The top ideas that we have in mind really are that on back of our view that the dollar is going to weaken from this quarter to the end of the year, is to sell dollar Singapore, dollar IDR, any rallies. In fixed income, we think that the bond market guys and bond investors are overly bullish on investing in terms of long-term government bonds in the U.S. and Southeast Asia. We don't think that is the trade. The trade really is on back over a macro view, which I'll talk about in a little bit, that we expect no recession in the U.S., no recession at the global level, and we're headed for essentially a second half recovery. Implies that in terms of risky assets in fixed income, we like basically corporate credit and essentially in some parts of the corporate bond world, we like high yield, mainly concentrated in the U.S. high yield space. In the equities world, we want to basically long equities on dips. The geographies that we like are particularly the United States, which so far, with the exception of the NASDAQ, has been lackluster. But we think the trade really is rather than at just the index level where we continue to position of being long at the Dow Jones Industrial Average Index, that at a sector level, we like U.S. banks as proxied by the MX US OBK index, which we think could return around to 10% in 2023. We continue to dislike China. We want to sell China on any rallies and buy India and Southeast Asia on any dips in the equities world. Our other counter-consensus view is that we like developed markets. We don't like emerging markets because we think that the big pickup in emerging market equities, emerging markets corporate credit that happened since October of last year is over because the outlook on China's economy, geopolitical risk related to China, as well as domestic policy risk as it pertains to essentially continue to implement the Common Prosperity Program means that the output for China's financial market is negative, and with that, it will drag EM down. In terms of commodities, given that this report was written like early April or published in early April, And even before that, months before that, we had been long oil, Brent oil, when basically Brent oil had collapsed below $70 per barrel. We continue to be long Brent oil. And that basically our average forecast for Brent oil is $80 to $90 per barrel. The main catalyst for our bullish view on risky assets, to reiterate, is that we think that the U.S. and global financial stability risks are very limited. We don't see any systemic risks from U.S. banks or global banks that is going to affect the market and economic outlook. In terms of the second key catalyst behind our bullish view on risky assets is that valuations, particularly our top idea is U.S. banks. The valuations there are looking very good. In that sector, the market is pricing in a crisis, which we don't think is gonna happen. Third, as I mentioned earlier, we see no U.S. recession, no global recession this year, including the second quarter. Markets have been trying to price a recession in the U.S. for some time, since actually several last year, and we call it a recession. That is not going to come. In terms of inflation, the outlook is improving. Clearly, we are past peak inflation in many parts of the world, and we think that the dynamics of inflation by the summer will suggest that essentially momentum is going to be decelerating for the remainder of the year, and that U.S. core PC inflation will hit 2%. That's our forecast by the end of this year. As far as the Fed goes, another key uncertainty for markets is that we continue to believe that the Fed will hike to 5.25 to 5.5% this year. No rates cuts are coming. We believe that the fixed income markets are mispriced, as they have been for quite some time. And we think that this mispricing is starting to come off now, as markets, at least in the fixed income and money markets, are starting to come to the RHB group view in terms of peak Fed funds rate forecast. So if you look at figure one on this page that you're seeing right now, look at the MSCI US Bats Index has collapsed, right? And that is suggesting markets are pricing in prices in the sector, which we don't think will happen. And the fixed money and fixed income markets are pricing in significant rate cuts as far as the Fed goes in figure two. Again, money markets and fixed income markets are suggesting a crisis scenario, which we don't think will happen. So how have we done so far in the year in terms of total returns? You will notice that equities so far in the year, developed market equities, in fact, have outperformed at a global level, particularly the Nasdaq, the German index, the DAX, and that some of the more developed markets, such as Korea and Singapore, have outperformed. At a high level, MSCI World has outperformed most bonds, and we're starting to see now that essentially the China's bond market, China's essentially equity market, is starting to basically now underperform. This is as of, if we look at the last data, this was as of April 3. The picture doesn't change much, except China's up a little bit, around 2% or so year to date. So what the markets are suggesting to you is that the trade is in equities. It's not really in bonds, and it's not really in cash, where we think that as time ensues in the second quarter of the year, you will be in a situation where investor sentiment improves further in terms of putting on trades related to risky assets. So to continue, what we are seeing already is that the investor sentiment on figure 44 is suggesting an improvement as basically global growth bottoms out in this first half of the year. And what the signal is, 6 months from basically the first quarter onwards, we should see an improvement in global growth and further improvement in investor sentiment. That's one key chart to think about very carefully. In the next page, you will see that as far as the U.S. goes, next page, please, figure 48, you will see that the U.S. equity risk premium has collapsed to below global financial crisis levels. And what that means is that the worst is over in terms of negative sentiment in U.S. equity markets, which drives the rest of the world. So the main message that I'd like to give all of you is one, is don't be distracted by the headlines that you see in the press of negativity, that basically we're headed into a U.S. and global recession, that there's a banking crisis coming at the U.S. and global level. That's not going to happen. The second thing is that if that's not going to be the case, and inflation, the worst of inflation is behind us, monetary policy tightening is behind us, and essentially equity markets start showing signs of recovery, housing market shows signs of recovery, it means essentially that buying risky assets on dips is the way to go. Our global asset allocation is essentially overweight equities, market with fixed income, underweight cash. And where should we be in the equities world? Well, we should be in the U.S., we should be in Southeast Asia, we should be in India, and essentially exit China on any rallies. In closing, I hope to see you at our RHB Morning Cup of Briefings by our RHB Research and Economics team every business day before the market opens, where we go live on our RHB Morning Cup at 8, Facebook group at 8 a.m. for more investment insights, market economic outlooks, trading ideas, and more. And that more could be some good jokes from our side as well. That's it from my side. Thank you for attending this podcast.